Good morning, good afternoon, and good evening, everyone, and welcome to the Daily Stack. We have the Thursday macro edition. This week, we are joined by Infra once again to run through whether or not one Substack post single-handedly pulled the market back down again, and whether or not Citadel's response was responsible for the rally back up. Is AI going to destroy the middle class of America? Is it bullish? Is it bearish? We're not sure. We're here to figure it out on the Daily Stack on Thursdays. If you are new and just tuning in, please drop us a follow on @DailyStackHQ. If you're not following Infra, give him a follow as well. He is every Thursday dropping some macro alpha with us. Infra, how are you doing this morning?
Hey, good to be here. A lot going on.
Yeah, we have markets volatile as usual. I mean, trading similar to the way Bitcoin's volatility trades. We have Citrini, this article that kind of came out of nowhere and was hypothesized or put to the market as a very much thought experiment, ended up doing a hell of a lot of damage. And I don't know if it was algos who were trading the market lower, or if it substantially had an impact on market participants sufficiently enough for them to actually play out the scenario and move markets negative for the day.
Yeah, so today I would say it's probably not much Citrini based, but we did, Monday, Tuesday, and Wednesday we did see some moves that I think I think legitimately were caused from this one article. It's pretty wild too. Just like I remember, years ago when I first kind of came across him, and he was, relatively small account, kind of, like I am. And to see him, or an article of his become, the A block of CNBC for 3 straight hours, and Wall Street Journal wrote a piece about it. Financial Times wrote 2 pieces about it, kind of in response. But yeah, I think it's really interesting the degree that the degree of impact that it had on the stock market, considering he in the first paragraph says this is not a definitive call. This is just kind of a hypothetical, and posing the question, kind of more, as you said, a thought experiment. And I think that there is so much uncertainty about AI. There's so much, and we can see this reflected in the markets. There's so much uncertainty about AI. There's so much fear. I mean, you look at like dispersion has been headed higher, implied dispersion has been headed higher. We've seen, going back to kind of late October, we've seen violent rotation in the equity market under the surface. Over the past month, we've had rates come in, nothing,
Sorry
shocking, but
Infra, but do we have charts on that volatility that we can run through, or is
yes.
this just generic, like more gut-based?
Yeah, I'll
volatility,
I'll
because I know that you're obviously super data driven, and that's a lot of the alpha that you're dropping is just much easier to visualize for me once we have. Awesome. Okay, so we have data over here.
So here's kind of one way to think about it. So here in red we have Bitcoin inverted, and then in white we have defensives relative to technology. So XLP is consumer staples, very defensive. You have utilities, very defensive, and then you have healthcare, very defensive. So what I did is I just combined those sectors and then took an average, divide by 3. Then I took that defensive kind of basket of defensive sectors and then divided it by technology. So when this is going up, defensives, consumer staples, utilities, healthcare, those are going to be outperforming technology. And when the line is going down, you have technology outperforming. So, the big trend here is that technology generally outperforms defensives. Consumer staples are generally in utilities and healthcare. It's generally kind of a boring, stable, non-volatile, dividend-driven sort of area. Generally, technology is going to outperform that. And that's kind of the bigger trend within what we're looking at here. So this particular chart goes back to mid-2023. And so what we can see is that as technology is outperforming or defensives are underperforming is probably a more intuitive way to think about it. As defensives are underperforming technology, Bitcoin does well because this is inverted up here. But when the market starts to become worried about either the market starts to become worried about growth and a potential recession, and so there's rotation into defensives, or what we're seeing, the market starts to become concerned about AI. You're going to have defensives outperform technology. And so what we'll see is, and that's what we have been seeing going back to late October, which is kind of the turning point. This late October period of time is kind of really when things started to really turn, in my opinion. And it was kind of confusing because it wasn't just defensives that were outperforming the S&P 500 or the NASDAQ. It was also industrials. It was also materials, which is kind of much more of like an early cycle indicator, right? That you're going to have materials, industrials, XLI, XLB. You're going to have those outperform the S&P 500 and tech. If the market is believing that we are kind of in the early stage of the business cycle and the growth is going to kind of start to accelerate, you would have those outperform. So, it's kind of confusing. I've been flagging this for a while now. It's kind of confusing. Like on the one hand, you have industrials and materials, which are very like early cycle indication, good growth, right? And then on the other hand, you have defensives, consumer staples, utilities, healthcare, those outperforming, which is very kind of bearish for economic growth. So, it's kind of like how can both of these be outperforming the S&P 500 and tech? Obviously, SPY very heavily weighted to tech in the Mag 7.
Yeah.
How can they both be outperforming? Well, the answer is that the conclusion I came to around the same time that Citrini put the article out was the market's not making a directional call on the U.S. economy. The equity market is making a call on AI and the disruption that AI is going to bring to namely SaaS and software companies.
Yeah. So, I mean, on that note, like, let's start with the setup, which is they published this, I guess, thought piece. Markets tank, or not tank, I guess. How big was the correction? The correction was what, 2 to 3%, which is a pretty big day for the SPY, right?
Yeah, I mean, the market was definitely worried about, I think it had some impact here. I'll take Bitcoin off of this chart here. So yeah, I'll go to the daily, so it's a little bit more intuitive. This was Monday. So this piece was published on Sunday, and Monday was the first trading day where the market got to. It's important, Bitcoin didn't really make major. It was the only thing trading kind of Sunday afternoon until futures. But futures opened up lower by like 0.5%. Not opened up lower, but within an hour had moved lower by about 0.5% Sunday evening. Now, normally you don't get, ES down by 0.5%. It's not a crazy move by any means, but it is unusual to have Sunday evening have a move that large in ES. And then Monday, we got, pretty sharp sell-off, closed near the lows, rebounded here over the past 2 days, Tuesday, Wednesday, and today, because NVIDIA, we're selling off pretty sharply today. NASDAQ down about 2%.
So, I mean, in the grand scheme of things, it doesn't seem like more than a spec, right? I mean, it's not causing any knock-on effects. There's no momentum that's built into this move. It's more of just a kind of a knee-jerk reaction to what could have been something real, and the market seemed to have brushed it off, relatively speaking.
Yeah, I mean, I think we're gonna have to wait to see if it's super durable. I would point out that the IGV is down, significantly. I think 40% from this double top here in late October. The IGV, the software ETF, this is what Bitcoin has been trading with a tight correlation to, down about 30% as of right now. It was down as much as 35%. So I think that there's already some amount now. Software companies going into kind of the Citrini article and going into 2026, software companies had a pretty high multiple, and the market had priced in pretty significant amount of earnings growth, which was clearly overly optimistic in a world with AI. And so you've had the multiple compress pretty severely here over the past couple months. But yeah, we'll probably have to wait to see. I mean, software, for example, is at a pretty decent support here. Software IGV has come down and tested 77 multiple times and bounced pretty strongly. So you probably get a bit of a counter trend rally here, if I had to guess. And you could do a set a stop loss here at 75.50 or something. But yeah, it's hard to not it's hard to believe that AI is not going to have some of the impact that we're already seeing. I mean, we already see a 20-year-old with Mac Mini vibe coding stuff. That, look, is it 100% of Adobe? Does it get the output? Is it 100% of what Adobe can produce? No. But does it get pretty close? Yes. You're there. You have 19-year-olds with a Mac Mini getting 85% of the way there.
Yeah, I think what kind of Citadel was getting at, and we'll get into this maybe in the next 20 or 30 minutes, was specifically the marginal cost of compute versus the marginal cost of, let's call them a middle class, citizen, worker, whatever you want to call them. Because in that article specifically, and you brought it up now, so let's dive in. They mentioned the compute capacity in a rural town in Midtown Iowa. And they specifically said, and I'll read you the quote because it's quite impactful. Let me see where it was. I'm having trouble finding it, but they were basically saying that in the relative compute of the amount of output coming from a small town in Iowa was essentially similar to 10,000 white collar jobs in Midtown Manhattan. And then the question is, is that trend going to continue? And what is the marginal cost going to be for compute relative to an individual worker? And will that end up hollowing out the middle class American economy, essentially?
Even further. Yeah.
Right.
And that's kind of the unfortunate thing, that going into this, it would be a lot different if labor share of income was not already at a record low. That's kind of the depressing thing. Now, I've been saying that for years now, that I think that all of the issues that I talk about, whether it be deaths of despair, labor share of income, real purchasing power of wages, all these sorts of things that I've been harping on, I've always said it's probably going to get worse before it gets better. And unfortunately, I think the AI is going to be kind of a prime driver. For example, corporate profits as a share of GDP have doubled over the past 25 years. Meanwhile, wages and salaries have declined as a share of GDP. And that's not even per capita, right? That is just looking at the average hourly wage multiplied by the labor force multiplied by 1820, which is about the number of hours worked, per person per year. You take the total amount of wages earned by humans in the US economy, and then you look at the growth rate of that relative to GDP. Now, if you're importing 20 million people, every couple of years, that should go up, right? Because more people now are in the economy earning. Yes, wages are going down, per capita wages are going down, but generally, like, the total amount of wages and salaries in the US economy is going to go up because the number of people working has gone up.
The overall pie is growing in that scenario, is what you're saying. Even though there's more people to divide that numerator by, you have a larger pie. So even if it is decreasing on a quote unquote nominal basis, it's still expanding at a high level.
Yeah, exactly. So you have, like, the average hourly wage that the individual American worker is earning, that is going to go down when you double the labor supply. But the total amount of wages earned should go up. And what we've seen is, yes, it has. The total amount of wages earned in the U.S. economy has gone up and to the right. But the problem is that GDP has gone up and to the right faster. So the question becomes, okay, well, if the average American is not, the pie is getting bigger, GDP is definitely growing, big number gets bigger every print. If that big number is getting bigger and the pie is growing larger, but wages aren't growing at the same rate, that's where you get a falling, what they call labor share of national income, or total wages as a share of GDP. That's how you get it, is that GDP and wages are both growing. The problem is that GDP is growing far faster. So the question becomes, okay, well, what is growing faster than GDP? If total wages and salaries is growing slower than GDP, what's growing faster than GDP? And the answer is debt, government debt. This is why debt to GDP. That's a formula there. Debt divided by GDP. Debt is growing faster than the overall economy. You have corporate profits growing faster than the overall economy, and you have the net worth of the top 1% due to financial assets growing faster than the economy. You can look at the Buffett indicator of stock market cap to GDP, right around 200%.
So I guess then the logical question is that trend accelerating? Is it slowing, or is it plateauing? Because that's kind of what Citadel were countering the Citrini article with. They were saying, hey, the marginal adoption curve is S curve based rather than exponential. And because we're humans, we don't necessarily know how to interpret new data correctly because we extrapolate it out into the future on an exponential basis rather than, or a linear when we should be doing exponential, and vice versa. But because of our human nature, we over or underestimate accordingly because of psychology. And if we model it based on S tier adoption, that curve actually plateaus as the marginal cost of compute continues to skyrocket. Because the one thing that the Citrini article, I guess, didn't account for was that plateauing, and it did assume an exponential growth of AI compute, because compute is exponentially expanding, right? But the cost of that compute isn't necessarily also infinite in terms of the capabilities thereof.
Yeah, I mean, I would just say, as a counter to the counter, if you look at like U.S. policymakers, and I don't think it's going to be just in the U.S. I think we're kind of ahead of the curve here, so to speak. They are looking at this as the next arms race. And so, when it comes to the amount of money, the amount of capital that can be expended into, the AI build out, I think that it's significant. I think that the U.S. government sees this, for whatever reason, as literally an existential crisis, an existential arms race against countries like China, and therefore, kind of what we would generally expect might be constraints when it comes to capital might not be as much of a constraint.
So, I mean, let's get into that. Why do you think they viewed this as an all or nothing type of issue or topic?
I don't really know. I mean, I'm generally I'm definitely not one of the kind of e-acceleration guys. Like, I'm generally kind of not in that camp. But yeah, so, I'm kind of naturally more skeptical and maybe pessimistic when it comes to technology and the impact that's had on society and where it's going. So, it doesn't really make sense to me. Maybe if you're in that camp, though, if you do believe that, and look, the Trump administration is surrounded by and filled with, a number of those types, the kind of David Sachs and the all in podcast guy, like that kind of crowd, Peter Thiel and Palantir and the ties there. Like, so I think that's part of it. Incentives at play when it comes to wealth. But yeah, when it comes to kind of the impact, the benefit for society, I don't think it's better for society for us to, spend $18 gazillion a year on data centers to build these algorithms whose specific purpose is to replace humans. I personally just don't see how anyone could think that there's a, I mean, I understand the land of abundance and, the singularity is going to save us. Like I get, I hear the argument that those people make, but I don't agree with it, or I don't see that the same kind of land of abundance where money doesn't even matter and we're all just, I mean, it's not, I don't get it. I really don't get it. I think it's going to make society so much worse. And kind of pointing to labor share of income and some of the kind of hard data. We all know consumer sentiment has been plummeting. The average American, when they reply to surveys, is very, very pessimistic, and they're in a lot of discomfort currently, and we see that in the soft data when it comes to the average consumer. But when you look at the hard data, that backs it up, right? Deaths of despair 3x what they were during the Great Depression. So the Great Depression was catastrophically
What
bad.
was that statistic? That was deaths and despair.
Deaths of despair.
Death.
So, yeah, deaths of despair is alcohol-related deaths, drug overdose deaths, and suicides combined. And the rate of deaths of despair, this is outdated data. I actually updated the data, but yeah, it's 3x what it was during the Great Depression. So this chart shows up until, or from 1900 up until I think 2017. So from 1900 to 2017.
Sorry to interrupt. Is this too crude of a data measure to associate with, like, quote unquote general happiness of a country? I mean, this might be
I
one of the charts, but like this looks like a very good placeholder for something that you would look at and say, hey, like, is a country's population healthy or not?
Yeah, I mean, I look at it like a survey and what an American says to a surveyor as soft data, right? When we're evaluating the U.S. economy and GDP and that sort of thing, there's soft data and there's hard data. Soft data is like ISM, PMIs, right? Purchasing Manager Index and that sort of thing. But then the hard data is like actual net exports, actual consumer spending. That is hard data. So I look at kind of trying to evaluate the happiness of a country or the health, societal health of a country the same way, which is you're going to have soft data. Well, we know the soft data is horrible. If you look at consumer confidence, for example, present situation, expectation, like everything is showing that Americans have never been more pessimistic,
Sorry,
at least.
to be, super specific, if you can go back to that, when you say it's peaked or troughed, that is in the last 20 years, 27 years, or is that all time going back to, I guess, the global financial crisis? Because
Well, Conference Board, yeah.
Americans have never been unhappier, but it's another thing to look at a chart and just, if it's within the last 10 or 20 years, do you know what I mean? I think we need to be specific about.
Yeah, as far as the data, well, so Conference Board, this data goes back to 2007. If you look at the, I'm totally blanking on the University of Michigan consumer sentiment, that goes back to the 60s, I think, mid 60s. But that shows current economic conditions at basically a record low. It set a record low a couple months ago, and it's
That's
barely.
fascinating.
Yeah.
That's literally that's in 67 years. that Michigan sentiment survey, that it goes back 67 years, and we're at the lower end, if not the bottom of that.
Yeah. So this is current economic conditions.
Wow.
Trading View says it goes back to 1951, and yeah, back here at the end of 2025, we hit a record low. So this is the valuation. This is how average Americans are responding, just on the phone, right? Someone calls them up, hey, how would you rate your current economic condition? Good, bad, very bad. This is what they're telling surveyors. But I think soft data is important. I think soft data is worth paying attention to, something like the University of Michigan Consumer Sentiment Survey. But, there's issues with University of Michigan, right? Like you look at the breakdown by political party and it's very skewed. Democrats right now, Democrats are very unhappy. Republicans are much happier. And, back during Biden, it was the opposite. So, due to the polarization, which I would argue is just yet another indication of general unhappiness, due to that polarization, you have a kind of dispersion in the responses. So, soft data, you have to take it through, it's not perfect. It's skewed by things like that, political polarization and the way that people respond in that way. So the question becomes, okay, well, like,
I mean, I'm not sure what companies that are interviewing, but I mean, the companies that they would be asking, or company owners that they'd be asking questions of in 2026 is completely different to the types of companies that would be running 40, 50, 60 years ago. So it is
well,
definitely different,
yeah,
right?
that's PMIs. Yeah. PMIs, and the Fed also does business surveys as well.
So this
What
is
we're
just
looking at,
your retail middle class American, and how do they
this is the,
demographically distinguish?
yeah, so University of Michigan looks at just kind of the average American, or they try to approximate with their sample. They try to approximate kind of the average middle class worker. Things like the PMIs are trying to evaluate business conditions, prices, new orders, those sorts of things. But when it comes to the health of the average American, or the happiness, University of Michigan is kind of the soft data that you can look to, that has, it goes way further back than Conference Board. And so you can look to, current economic conditions, very, 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 very low. I mean, lower than 2008 in the great financial crisis. Very, very, very low, here for how average Americans are rating to, on the phone, just, giving their opinion. This is what they're saying. But what is the hard data for the happiness of a society? I think that there's probably nothing more reliable, more hard, than, are people killing themselves? And once you look at that, it's very bad. So the deaths of despair are double, or have doubled just over the past 25 years. If you look, and this is a rate, by the way, this is not like a number. I get a lot of, like, anytime I talk about this stuff or post these charts, people always say, well, that's not a rate. That's, total number, and the population is growing. No, no, no. This is per 100,000 people. So it's adjusting for population growth. This is saying, out of 100,000 people in 1930, 1950, whatever, how many of them are dying due to, how many of them are killing themselves? How many of them are dying due to drug overdoses or alcohol related, alcohol poisoning and that sort of thing. So I think there's no more kind of hard data for the health of of the average American or any society than to look at how often are those people literally killing themselves. I mean, there is nothing more hard than that. And yeah, it's doubled just in the past 25 years, more than doubled. And currently, the rate is actually even worse than this. It's 3x what it was during the Great Depression.
So not only are you adjusting for population growth, which is why that rate is so important, but this is really the thesis behind the silent depression, right?
Yeah, I mean, it's indicating that, it's one thing, there, you don't really have much at stake. Someone calls you up on the phone, they ask you some questions. You don't really have like a stake when you give them the answer, So yeah, like all these various different surveys, and we're seeing more and more. There was just one a couple days ago that came out, some survey done by, Intuit or someone, that, is trying to gauge the happiness. All those surveys, while they're important, they don't really, like, there's nothing really on the line. Or people can give whatever answer they want, but when they kill themselves, or they are so economically hopeless, they look around their country and they have so much despair that they go and get addicted. People don't get addicted to fentanyl for no reason. And so yeah, I think that there's kind of no more reliable data, how happy a society is, than the rate at which people are dropping out of society. and like permanently. This is not like a temporary dropout. When you're gone, you're gone. This is a permanent solution, and that's always kind of the adage for those that have worked in that industry. It's a permanent solution to a temporary problem. Well, what this is showing is that it's not really that temporary. If you look at labor share of income, it's just plummeting and plummeting and plummeting and plummeting. So it's just getting worse and worse and worse. There's kind of no bounce in sight, unfortunately, for the average American. And I think AI is just going to make it worse as it displaces the need for human labor.
Well, so I mean, again, let's get into that in terms of AI displacing the need. That's really what kind of Citadel was rebutting, was saying, we hit this plateau, and you guys are looking at this hypothetical scenario in 2 years where we have massive unemployment. But if you look at some of the data, and they shared one specific number as well, which was they were looking at the
business applications.
Well, they were looking specifically at software engineers in the article, and they said,
"Oh,
hey,
the Intuit job postings." Yep.
Correct. So look, maybe there's manipulation in that data, but if you look at a graph of those Indeed job postings, I don't know if you want to bring them up.
Yeah, I have it up. Yep.
Awesome. So if you look at that graph, they're saying, hey, Indeed, the job postings in light blue are actually on the up and up, and they're moving in the right direction. So for someone arguing that, AI is going to take over all jobs, this is probably one data point that would counter that fairly well.
Yeah, I'm not a software engineer. I know a couple, two or three that are software engineer that have either starting to enter that sector or have worked in that sector for a while. And the way, I mean, what they're telling me is not that there is an abundance of job openings, especially given what we're doing, continuing to do, despite what one half of the country thinks. The Trump administration is still very kind when it comes to corporate profits and corporations' desire to import high skill labor. The H-1B discussion. This administration, while they are cracking down on certain components of immigration, and net migration has gone negative, while they, that is all in the headlines. What's not in the headlines is the number of H-1B applicants, and that's obviously like a more of a white collar sort of area. And what they are telling me, and I've asked a couple specifically about, I've asked two of them specifically about this posting this morning, and because this is about as far as I got in the article here. Recursive technology does not equal recursive adoption. So I'd seen this, and it kind of caught my eye. And I decided to ask, is this real? Like, if you were going to leave your job, software engineer at company A, and try to go get a job as software engineer at company B, what do you think your prospects would be? And it could not be more negative. What both of them told me in terms of kind of the overall health of the industry. And if demand is really truly increasing, but you're increasing the supply via H-1Bs, then if you're an average American, does it really matter that demand, if demand is even rising, does it really matter if corporation A, corporation B can just go and go behind your back and hire someone for, I don't know, half the cost, whatever the actual clearing price for that labor in America, native born American, if a corporation can go and outsource it while the person is technically living in America, you're essentially offshoring that job to someone not from America who's living here temporarily on a visa. Does it really, do you really care? Does it really benefit you that demand for software engineers is going up if the supply of software engineers is going up at the same rate, if not even higher? And that's kind of like what our policymakers from both parties have done for the past, I don't know, 5 decades, is they've increased the labor supply, not just with high skill, white collar labor with the H-1B sort of stuff, but also, of course, low skill labor. A lot of the jobs that back in the 1950s, 1960s, an American high school kid, would go work, are no longer, it's no longer Americans that are working those jobs. the effect is the same, which is that it's going to compress, it's going to suppress wages. And sure enough, that's like the mega trend. The mega trend is that wages, even not adjusting per capita, even accounting for the fact that the labor supply, the workforce is growing, even then wages as a total wages as a share of GDP has been plummeting, and it's because both parties, have engaged in and allowed immigration policy both on the high skill and the low skill. I mean, remember it was Reagan, right? This is not like a partisan thing. It was Reagan that did the amnesty back in the 80s. So it's not really a partisan thing. Both parties have in the interest of corporate profit margins and equity returns of those corporations, and therefore the wealth of the top 1% that own all those equity. Uh, they have put that at a higher significance than the average American whose wage is getting suppressed. And look, that's very good for the bond market. The bond market enjoys that. It enjoys that wage suppression because it's not inflationary. If you are mechanically kind of suppressing wages by the artificial increase of the labor supply, then inflation is going to be a disinflationary force, which the bond market enjoys, right? Because what is the antidote? What does the bond market hate the most? It's inflation. So, and what is the bond market? The bond market is the government's credit card, right? For all this kind of corrupt, self-dealing sort of spending that we know both parties do. And so, in the interest of keeping corporate profit margins high, therefore equity returns, therefore financial assets high, and in the interest of not blowing up the bond market, which is their credit card for all their corrupt kind of internal self-dealing, they have both parties have engaged in this kind of artificial increase in the labor supply. And we see it, for example, with regard to the software engineers. A lot of people focus on the illegal immigration side and the low skill and the effect there. But not now. Recently, more people are talking about kind of the high skill white collar story when it comes to the labor supply and the policies that are not being reversed by this administration to allow for an artificial increase. The issue is that the true clearing price of labor, if you remove that the importation and the kind of artificial increase in labor supply, if you remove that, the clearing price for labor for, say, a software engineer is probably significantly higher. And what will that eventually cause? Because it will cascade not just white collar but also low skill. Wages going up blows up the bond market. And what is the bond market? The bond market not only would cause a financial crisis if the bond market blew up, but it's also the government's ability to continue to spend money that they don't have. So I'm pretty pessimistic that someone comes around and they're like, oh yeah, we're going to actually enact policy to increase labor share of income, because it's even worse if you look at the per capita wage as a share of GDP, relative growth rate of the average hourly wage relative to GDP, it's even worse. So here is the average hourly wage relative to GDP, and you would think that if GDP is going to increase at, I don't know, 3%, 2.5% each and every year, the economy is growing at 2.5%. Well, I think most people would agree the average hourly wage should increase at 2.5%. That is what the blue line is showing, is that it has not. In fact, it has trailed GDP growth going back to the mid 1960s by 71%. The average American, my neighbor that I was talking to the other day, they don't care what total wages as a share of GDP is. They don't care. They don't care labor share of income as a total, right? They care about their average hourly wage. Well, their average hourly wage has trailed GDP by 71% going back to 1965.
So if you were to, I mean, in my eyes, this is the collapse of the American dream in one shot.
Yeah, I mean it's a lot worse when you look at corporate profits. So if you look at corporate profits as a share of GDP, or the net worth of the top 1% as a share of GDP. Again, meaning that, this green line, we're looking at corporate profits as a share of GDP. This green line is going to go up if and only if corporate profits grow at a faster rate than GDP. So if GDP is 2.5%, the economy is growing at 2.5%, you would expect corporate profits maybe grow at 2.5%. But what this shows is that corporate profits have grown twice as fast as GDP and the overall economy. So the pie is definitely growing. The overall pie, GDP, big number, gets bigger every print. The pie is definitely growing, but the problem is who the distribution or the composition within that pie. Corporations are growing. Corporate profits are growing a larger and larger share. Corporate profits are growing faster than the overall economy. Meanwhile, the average hourly wage is trailing the overall economy and economic growth. So, corporate profits have grown faster in GDP. Government debt to GDP has grown faster. What kind of economy, is the American dream alive when, you have the average hourly wage and even total wages growing much slower than the overall economy and losing share? Meanwhile, what's gaining share? Well, it's corporations, corporate profits. The returns in the equity market, who owns all the equity? It's the top 10%. They own 92% of household equity exposure, just the top 1%. So, it's kind of bleak. You have an ever smaller number of people, enjoying an ever larger share, an ever smaller group of people enjoying an ever larger share of U.S. economic growth. And I think I don't see a world where AI does not make that infinitely worse until eventually it breaks. And I think, none of us really want to see it break. But that's, we know that is kind of how these long cycles, if you adhere to like Peter Turchin and Neil Howe and those guys, they talk about these long lifetime cycles. And, unfortunately, it's probably got to get worse before it gets better.
Well, that's really the crux of anyone who's listening to this or tuning in, is the question: is Bitcoin going to 10K first or a million first, right? Because that end cycle that plays out where shit hits the fan is really the breaking point, and timing that breaking point is the most important thing here, right? It's not necessarily knowing that it exists, because I think we could all agree that probability weighted framework, if you look at historical societies and how those are played out when the money gets debased, we all know that we're heading for an event, but if that event occurs in 2 lifetimes from now, then why do I care? And that's really why I want to tie this all back to Bitcoin. Is AI going to be this deflationary shock? And if so, over the short term, the medium term, the long term, like who's right between Citrini and Citadel on when this is going to occur? Because timing is, as with everything in life, the most important question.
Yeah, so I think it's a question of time frame. I think that over the next 2-3 years, we've already seen productivity. Q2 of last year, you got every single revision on Q2 2025 Q2 productivity. Every single revision was revised higher, and the final print was 3.3, far above expectation. Then Q3 productivity for last year, even higher, 4.9%. So we already see productivity data starting to show this kind of effect that we're talking about. You can also see the effect is already starting to take hold if you look at certain cohorts within the labor market data. Young people, recent college grads, those sorts of jobs are already showing major pain. So I would argue that the effect is probably already starting to be being felt. That deflationary effect is already starting to be felt. It just kind of depends, right? Like if you're a boomer and you're looking at your Zillow and your house is 10x what you bought it for, and your stocks are, up and to the right, do you really feel, you're retired? Do you really feel the impact from AI? No, probably not. But you talk to a recent college grad, for example, and they they feel a much different impact. So how fast it progresses, so the point there being, I think is already here. I think it's already started. I mean, 4.9% productivity that's red hot territory, considering where productivity data has been historically. So I would argue it's already here. The pace of how fast it increases, the curve, whether it's exponential or linear, and where it all kind of plays out, I'm not sure. I would think that over the next 2 years, 3 years, 4 years, that the kind of deflationary impact from AI is going to be a durable trend. But I think that there is kind of like this end state that, as long as you can look through the next 2 years, 3 years, 4 years, whatever it ends up being, as long as you have a low time preference, there is nothing more bullish for Bitcoin than a recession. I've been saying that for years, and I still think it's true. Now, you have to be able to stomach volatility. You have to be unlevered. But if you can, and you have a low time preference, I think that there's nothing more bullish for Bitcoin over the next 10 years, 20 years, 30 years, because what this deflationary spiral will end up causing is a U.S. sovereign debt crisis. And this is the problem that policymakers have gotten themselves into with all this debt and a 6% of GDP pro-cyclical deficit and a 3.5% current account deficit. This is the problem they've gotten themselves into, is that we can't really tolerate, a recession basically essentially acts as a margin call on the debt. So in my article, I modeled out, I kind of revised an article that I did back in, I think, July 2024, that modeled out the effect of a recession. It was called "Why the U.S. Can't Afford a Recession." And if you look today using current data, the deficit would blow out to like $5 trillion. So that's 15, 16% of GDP. That is a huge amount of debt that has to be issued each and every year just to maintain the government, right? Just for the government to keep the wheels on the bus. 15%. Imagine this: you make $100. That's your total income. $15 of that each and every single year would have to be reinvested in U.S. debt. 15% of GDP deficit is enormous. And we kind of briefly reached that during COVID. But yeah, you're talking a $5 trillion deficit with a recession, with an economic growth forecast of kind of moderate deflation, nothing crazy, just 2-3% deflation, pretty high productivity, just kind of a relatively vanilla productivity boom from AI, which I don't think many people really disagree that much with. You're flirting dangerously close to a sovereign debt crisis, given the amount of leverage that's in the system, given 125% debt to GDP, given 6% pro-cyclical deficit, given a 3.5% current account deficit. All those things mean, and by the way, if the current account deficit improves, all that means on the other side of it is that there's less foreign capital flowing into your financial markets and your debt. So ironically, kind of balancing the current account would mechanically reduce the amount of demand or purchases, capital inflows into the treasury market. So like they're stuck. All that to say, that they're stuck. And if we get kind of the vanilla outcome here, $5 trillion deficit with 15, 16% of GDP, the Fed's going to step in and they're going to print an ungodly amount of money, because it's not going to be just the US government that's in trouble here. It's going to be private credit, which has huge exposure, relatively speaking, about 40% from the research I've read, about 40% exposure to software. So if software continues to be disintermediated, private credit's going to be a problem. Private credit's trillions of dollars large. The Fed will have to step in and backstop private credit. The mortgage market, over $10 trillion large when it comes to the mortgage market, that'll have to be backstopped. So like, as long as you can look through the next 2 years, 3 years, whatever it ends up being, as long as you can look through that kind of near-term deflationary shock from AI, 10 years from now, 20 years from now, well, maybe not 20, because there is a world where they print an ungodly amount of money and then we go into deflation, significant, real, like Great Depression level deflation, and you don't want to own Bitcoin in that world. But during the money printing, when the policymakers are eventually forced to come in and backstop private credit, the mortgage market, the fiscal deficit, and monetize the deficit, in that world, Bitcoin goes to millions, because of the amount of money that will need to be printed. But you can make an argument that after that is probably going to come a Great Depression deflationary sort of world. But in that inflationary deleveraging that comes as a result of a deflationary force, this is why I've always been kind of saying that, like, there is no bearish case for Bitcoin. People would throw out to me, oh, well, productivity could come in at just the right pace, and it could be the kind of panacea for the. It's like, we're seeing it. We're seeing what's already starting to happen with AI and the productivity from that. If it comes at just the right rate, that is true. But the problem is you can't control something like AI. The cat's out of the bag. I mean, every new laptop has a Microsoft Azure or whatever, shipped on it. Like, there's open source model. We're not controlling this bomb. That's why I call it a bomb.
Well, so if I was to counter that from, let's say, a non-Bitcoin standpoint, my simple question is, why would I want to own Bitcoin in that scenario if they are going to print an ungodly amount of dollars? Why not just own the quantum ETF if we're trading very closely to that without having to go through all the self-custody hassles and all the additional complexities that come with the benefits that, as a Bitcoiner, I appreciate in terms of self-sovereignty. But if that situation unfolds, why would I want to own Bitcoin as opposed to some other high beta asset?
Yeah, I mean, I'm very heavily long on Bitcoin, and I'm looking ahead to what could be a lot of pain over the next, I don't know, year or two. And so I'm trying to think. I definitely don't want to sell my Bitcoin, because I personally don't want to have no protection. I don't want to have 0% of my wealth in a sovereign, self custody, decentralized sort of vehicle. I don't want to have 0% ever. So, like, I don't really want to sell my Bitcoin here. But I also am seeing, potential, like, significant downside. So I'm personally looking at, like, IBIT puts as a hedge to my significant Bitcoin position. But I think the benefit of Bitcoin over something like, I don't know, QQQ, or right, because those are going to go up a lot when the government prints a lot of money. Those will go up a lot too. They will first probably decline a lot. I mean, the Citrini article modeled, I think, like a 45% decline in the S&P 500. So first they'll go down a lot. Then they'll come in. They'll have to print an ungodly amount of money. I don't think I even mentioned UBI, which would be required in this world. So you have private credit, $10 trillion mortgage market. You have the fiscal deficit. You have all of that, and you also have UBI. So the amount of money that would need to be printed is just ungodly, and the S&P is going to decline a lot going into that. Bitcoin is probably going to decline a lot going into that. But Bitcoin, like, the other thing we're not talking about, we're just kind of purely talking about the numbers. The other benefit of Bitcoin is that in a world of increasing political polarization, in a world of increasing kind of societal strife, Bitcoin, like, you memorize 12 words and you have a significant amount of wealth, depending on the person, just 12 words in your head. I think the ability to transport your wealth with no permission structure, right? You are not relying on any centralized permission to allow you to either sell it or transfer it, whatever it may be, or store it even. I think that is going to be increasingly valuable. Right now, it might not look, that value proposition of Bitcoin might not look to the average person they might not be ever like realizing the value proposition of that. But I think over the next, 5 years, 10 years, with political polarization only on the rise, with societal strife and discomfort and unease and unhappiness only on the rise, I think that it's going to be very, very, very valuable to have an asset that is scarce, number one, so you're protected from the money printing bazooka that is inevitable with this sort of thing. And you're also able to just memorize 12, 24 words, transport your wealth. If you have to flee the country, you can flee the country with it all in your head. No one ever knows. I think that sort of thing is going to be very, very, very valuable, unfortunately, right? Because you don't really want a society where that sort of asset is very valuable, because it implies that societal strife and all those things are sky high. So you don't really want a world where that value proposition of Bitcoin is important. It's but if you're looking ahead to the future, I think it's
you may not want that, but if that's the reality, then buying Bitcoin with the same exposure that you would get from QQQ or levered exposure to a quantum ETF, for example, with the additional embedded optionality of a self-sovereign asset, should that become relevant in society, is incredibly attractive.
Yeah, exactly. Yeah, and I'm still I still like gold. I still think that kind of like long term, gold is another. It's in the same vein, right? It doesn't have all the properties of Bitcoin, or it does, but it doesn't do them as well as Bitcoin. But I think that from a purely financial markets and return and risk adjusted return sort of standpoint, I think gold probably offers a better Sharpe ratio over the next 10 years. If I had to make like a prediction, I would say gold probably has a better risk adjusted return over the next couple years. But Bitcoin is does everything that gold does, but better, in my opinion. I don't really even think it's an opinion.
Yeah, no, totally agree. And I think on that note, we are going to wrap this to a close. Infra, thanks once again for hopping on. If you did listen to the live show, thank you so much for joining us. Drop us a follow on X at the Daily Stack HQ. Infra, you're on at infra_, I believe, with infra with 2 A's.
2 A's underscore, yep.
2 A's underscore. Give Infra's article a read, the one that he just dropped a couple days ago. I know he spent a ton of time on it, and it's really very high quality, in my opinion. So once again, thank you everyone for tuning in. Appreciate it, Infra. We will see you next week, Thursday, for another macro show. Looking forward to it.
Sounds good. Have a good one.
You too.